I'm going to go through a quick market outlook. I should mention that every employment day, so last Friday, I do a YouTube video which goes through in more detail the outlook for the economy and the markets.
By the way, while she intros, I just quickly want to say I didn't press live quickly enough for her whole disclaimer. So basically, if you lose money with whatever they say, it's not their problem. Okay.
So just to start off on the macros, fiscal policy, a $1.5+ trillion package is likely. And we have Larry Summers, a former chief economic advisor for President Obama, who is suggesting that if fiscal policy is that stimulative, the economy will be on fire. And I tend to agree with that. So I think we are in a V-shaped recovery. It is still the case that businesses are scrambling to keep up with demand. They're just now starting or able to build inventories. We saw in the employment report last week a 0.3 hours increase in the manufacturing work week. That's a telltale sign that they are really struggling to keep up. And so what usually happens in an environment like this is, the scramble to keep up goes into overdrive, which it will with all this stimulus. And then we'll see in 2022 if we will have overdone it and have a bit of a correction because of too much inventory. Sometimes we get equal and opposite reactions. So we do think the fiscal policy push here is going to increase businesses' confidence to keep chasing business and increasing capital spending. Monetary policy is aiding and abetting. M2 is up more than 25% on a year-over-year basis still, and yet it does seem like the biggest beneficiary so far are asset prices. So housing, equities, fixed income, commodity prices, including copper, which is corroborating this V-shaped recovery, the commodity with the PhD. At least that is how it used to be known. And we're not seeing wages pick up dramatically here. I think if we do see that, that's when the Fed would really take notice. I think most of them have been educated from the point of view that once inflation moves into wages, it is becoming endemic. And we're not seeing that yet. What we are seeing is average hourly earnings up 5.4% year over year, more because of a mix shift towards higher paying jobs. The service sector jobs are the lower paying ones, and those that have been hit the most by the coronavirus crisis. In terms of profits, we think they're going to be pretty explosive this year. The upward revisions are continuing, and again, fiscal stimulus will probably take them up another leg. So earnings are supporting the equity recovery, to be sure. And I guess the recovery, now that we're hitting all-time highs, can be described once again as a bull market. So are stocks in a bubble? Well, there are a few telltale signs that they are not, although we do believe there is a bifurcation taking place, and I'll explain that in a minute. We have found that the flows into mutual funds and ETFs have been instructive in terms of giving us a sense of whether or not there's a bubble out there. Equities have been outflowing pretty regularly since 08-09. There's been an asset allocation shift towards fixed income, which has been inflowing. So I think since 2018, and I often use January of 18 as an important marker because 2017 was such a good year for equities that we thought surely there will be now nice inflows into equities. Since January 1 of 18, there have been outflows from equities cumulatively, roughly 300 billion, although very recently we've started to see inflows. Nonetheless, that's a cumulative 300 billion in outflows. And we are not counting here share repurchases by companies themselves. And then on the contrary, there has been an inflow into bonds, which is approaching $1 trillion. So just giving you those two statistics would suggest that if there's a bubble anywhere, it is not in the equity market. It is in the fixed income market. Within the equity market, we do believe there is a bifurcation developing. And I know many of you will probably believe that I'm about to talk about highly valued stocks versus stocks at much lower valuations. And to some extent that is correct, but I'm probably not going to address it in the way that you expect. The bifurcation that we are seeing more and more, and that we think will be impacting stock prices in a much more intense way going forward, is the bifurcation between those companies that are on the leading edge and of innovation and have been investing to become a part of the massive innovation that we're seeing today, versus those companies that have not been doing that. In fact, they basically were catering to the short-term investment time horizon of investors who rewarded them for financial engineering. So buying back stock and doing so by leveraging up, also paying dividends often by taking on more leverage. Those companies, by and large, cater to a short-term time horizon, but are going to be, we believe, on the losing end of the massive move towards innovation that we're witnessing today. The companies with the very high valuations, and you'll find them in our portfolios to be sure, they're there for a couple of reasons. One, they have been investing aggressively. So they are foregoing short-term profits in order to invest aggressively in the exponential growth trends that we have entered in many cases, and that we will continue to take shape during the next 5 to 10 years. They are also often, and we'll throw Tesla, Square, Roku into this category. They are evolving platform strategies that are winner take most, or winner take, the 1 or 2 slots out, or 3 slots that are going to be out there for platforms that are going to be much more global than has historically been the case. Now, Amazon has shown the way, to be sure, but now this is moving well beyond retail. We think autonomous taxi networks are going to be pretty much natural monopolies. It'll be geography by geography, but those with the technology, and we believe Tesla has the technology and is focusing on doing autonomous the right way, it might have more success than even we now think is possible in other countries. Square and Roku are also entering other countries. PayPal, we saw in their announcement, breakthroughs in China and so forth. So whereas before valuations used to be influenced by a company's market position in one country, or one region. We think global, especially when it comes to anything digital, is the right way to think about these stocks. So we think that these companies will grow into their valuations, much like Amazon has been doing over time, as they enjoy enormous scale over time, going global. The companies that have been using financial engineering to deliver consistent earnings growth via share repurchases or consistent dividend increases, again, using leverage, we think they are going to have a tougher time. So we do not think stocks as a whole are in a bubble. We don't even believe the platform companies that I just described are in a bubble at all. We think the markets they are going after are enormous and they are global. So we think instead that there are a lot of value traps evolving in the market. And value traps, as any value investor will tell you, are where stocks become cheap for a reason, and they become cheaper and cheaper over time. Their book values they face write-downs. Their dividends are going to be cut.
Is she going to slam GameStop?
As the old world consolidates to just a few players, like we're seeing in the retail space, once again, the Walmart, the Costco's, the Targets. Now, as far as bonds, we do believe they're in a bubble. I've described the flows to you. I also think we've seen private equity feeding this bubble. It's amazing to me to watch how private equity, especially with mature companies, will continue to leverage them up so that they can enjoy the private equity distributions over time. And what they're doing is they're sustaining very high cash flow multiples, again, by not investing in the future. And that becomes problematic for these companies, and their high cash flow margins will disappear over time. We're also seeing the phenomenon like the GameStops and AMC, the moonshots that they've enjoyed because of call buying and catching hedge funds off sides. What we've seen there is a company like AMC, whose bonds were selling at 5 cents. I looked at the most heavily traded bonds in AMC in October. Sometime in October, I believe they were selling at 5 cents on the dollar, and they have moved up to 80 cents. And why have they done that? Because the move up in the stock gave AMC the opportunity to do an equity offering. So what's happening here? Equity holders are bailing bondholders out of their mistakes, or if companies have been opportunistic in picking up bonds for 5 cents on the dollar, they've hit a grand slam in the context of the bond market. But who will be left holding the bag if AMC goes bankrupt? I don't think one equity offering is going to change their circumstances. Equity holders who, again, have bought into a very mature company and thinking that someone is going to be able to resurrect it from the dead. Maybe someone will, but it is a long shot. So we think that this phenomenon has actually increased the bond bubble out there, and we're kind of astonished by it, actually. So with that, you know what side we're on in terms of this argument. We believe that the
paper hands
platforms, so DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technologies, which involve 14 different technologies that are going to be scaling, have already started, and we believe will continue to be scaling exponentially during the next 5 to 10 years are going to be the big winners, and they are going to create a lot of losers out there. So this move towards passive investing that we've seen during the last 20 years since the tech and telecom bust and the 08-09 meltdown, that now is a setup for disappointing returns from the broad-based benchmarks and various indices. We would implore that investors, if they are loaded up on very cost-effective investment strategies, again, they could be cheap for a reason, at least have a hedge and invest in some of these areas of innovation that we do think are going to deliver outsized returns over time.
In other words, don't invest in the S&P 500. Come invest with ARK.
This presentation over to Yassine El-Mandra, who is going to discuss Bitcoin and some of the exciting developments in that space during the last week. Yassine?
Thank you, Cathie. Indeed, some exciting news yesterday. Bitcoin soared to new all-time highs after Tesla announced a $1.5 billion balance sheet investment into Bitcoin. This is equivalent to about 9% of its cash balance. So now trading at around $47,000 per coin, Bitcoin's market cap has now surpassed $850 billion. Yesterday was also the first time that the combined market cap of Bitcoin and Ether exceeded $1 trillion. Now, as a part of this announcement, Tesla also said that it would start accepting Bitcoin as a payment method for its products. So this news really seems to have marked both a cultural and institutional tipping point for Bitcoin. Now, in our most recent big ideas, one of the primary opportunities we laid out coming into 2021 was Bitcoin's role as corporate cash. This was initially catalyzed by MicroStrategy and Square, and now Tesla. I do think that Tesla's decision has really legitimized this opportunity much more than MicroStrategy and Square, given that it is both a thriving company and it hasn't had any prior involvement in Bitcoin, as opposed to a MicroStrategy, which many have argued has used Bitcoin to perhaps remain relevant or even distract it from its struggling core business, and Square, which we know has already been involved with Bitcoin for years now. So Tesla's decision could very well be the beginning of a new wave of corporations who are looking to diversify their cash positions. And in big ideas, we size that opportunity, which you can see on this slide here. According to our research, a 1% allocation by S&P 500 companies into Bitcoin, cash allocation, would have a $40,000 impact on price, while a 10% allocation would have a $400,000 impact on price. For context, Square's has about a 2% allocation relative to cash, and Tesla closer to 10%, and obviously MicroStrategy has even more than 100%, given also their recent debt offering that they raised just to purchase Bitcoin. Now, the unique thing about Bitcoin, and if we want to go to the next slide, is that the use cases or opportunities that drive demand are positive sum. What this suggests is that a corporate balance sheet opportunity, or the corporate balance sheet opportunity like we saw in the last slide, is really just additive to all other opportunities. And in fact, in the white paper that we published in September, we didn't even include that corporate balance sheet opportunity. What we did include was Bitcoin as an investment for major institutional investors and asset managers, which, as noted in this chart, would have between a $200,000 and $500,000 impact on price. Now, deconstructing this chart a bit, to model the potential Bitcoin weights in the portfolio, which you can see in the second and third bar, we used a Monte Carlo simulation method that simulated 1 million portfolios based on traditional asset class returns, and then zeroed in on the Bitcoin allocations that would minimize the portfolio's volatility or maximize its risk-adjusted returns. So this comes out to around a 2.5% allocation when minimizing volatility, and around a 6.5% allocation when maximizing risk-adjusted returns. you can see that some of the stakeholders include pension funds, sovereign wealth funds, and even insurance companies. And this chart we actually made prior to MassMutual's decision to invest $100 million of their own balance sheet into Bitcoin. So we expect this trend to continue. And now with Bitcoin today nearing $50,000, this means that there still is room potentially to run. It could continue to scale by an order of magnitude, according to our research, and ultimately reach between a $5 and $10 trillion market cap.
That's huge.
So with that, I will hand it off to Tasha.
Thanks,
What's
Yassine.
Tasha going to talk about?
So as Yassine mentioned, it's been in the news quite a bit lately. Tesla's decision to buy Bitcoin and eventually accept it as payment. If you think of our work on ride hailing, this could be very relevant here. Cathie mentioned we're thinking about ride hailing, across the globe. And Tesla's a global automaker today. So if they're going to accept payment in a number of different countries, you can picture Bitcoin being a very efficient way to do so. Versus taking on those direct foreign currencies, they could accept Bitcoin. To frame sort of our ride hailing work, and this is from our latest Big Ideas deck. We think that the operator piece of the puzzle, these are the companies that own the technology stack, like Tesla or like a Waymo, the companies that actually make the car drive autonomously. Will take, it'll be an Uber-like model, although, the ride hailers are not necessarily the best setup to be these autonomous platform operators in the future. But an Uber-like model where you take a cut off of gross revenues. And we think this could be a very profitable business. You could imagine EBITDA margins of, around 50%. So if we look at the market globally, we think that the earnings opportunity for autonomous ride-hailing platforms by 2030 could generate more than $1 trillion in earnings. And if you think about the rest of the value chain, you can see here on the slide, we're also showing auto manufacturers. So this could be a company that has an expertise in electric vehicles. We think all of these vehicles will be electric from an operating cost, but also just from a technological perspective, this makes the most sense for autonomous platforms. Those players we think could enjoy up to $250 billion in operating earnings by 2030. And then the fleet owners. So these are players that could own, house, maintain the fleet. This could potentially be a company like Avis, that needs to transition to this autonomous future. Right, their business model today is a bit threatened by this opportunity, so it's probably advantageous for them to do so. So the fleet owners could enjoy about $70 billion of operating earnings by that time frame. And then looking nearer term, by 2025, if you take, we think those platform providers could that could be roughly 190 billion opportunity in earnings. If you take a 20 times multiple to that, this could be about $3.8 trillion of enterprise value attributed to those autonomous platform operators. And very little of this is accounted for in the equity markets today. I mean, we're really just starting to see more and more analysts, even think or talk about autonomous technology as they put out their valuation notes. Yeah, and with that, I think I'll pass it back to Ren.
Thank you, Tasha.
Huge enterprise value, they think, of 3.8 trillion by 25.
Today's webinar. So I've noticed several questions around ARK's recent growth, the size of our strategies. So this first question is for you, Cathie. I'll try to incorporate all these questions into one. Could you just share your thoughts on capacity for innovation-focused strategies?
Okay. All right. Thank you, Ren. I think this is an important question, and we do want to address it.
Hey, ask me some questions.
When we started ARK in 2014, not that anyone was asking us about capacity then, but we thought carefully about this, is we believe that if we're right and the platforms and technologies scale the way we expect, and you just saw Tasha's scaling, and of course Yassine as well, that our capacity should scale exponentially as well. Now, our capacity has, our growth since the bottom of the coronavirus has been fairly dramatic. And I think when people say, oh, they're forced into larger cap stocks, well, I can give you a few examples where market caps went from 250 million. This would be one example. Invitae, roughly 250 million, if I'm not mistaken, to 8 billion. And we have a lot of stocks in that category that have, they were depressed enormously during the coronavirus crisis, but they actually came out flying because they're solutions to the problems that the coronavirus crisis has created. So that is one source of capacity, just this idea that, okay, innovation solves problems, let's allocate more capital towards innovation. And we are seeing that. You're certainly seeing it in the SPAC space. Last year, there were $82 billion of SPAC issued. And I think that this year to date, and we're, 6 weeks through, we might be over $20 billion already. I think with the announcements, we're well over 20 billion, but actually issued. We also saw IPOs last year, was 406 deals, totaling $148 billion. Of course, most IPOs have, I say most, not all, have innovation associated with them. To give you a sense, in 2019, there were only 235 deals, so they nearly doubled last year. And they raised roughly $69 billion, so that the amount raised was more than 2.5. And then when you look at secondaries, we saw in 2020 $97 billion worth, and that was 164 deals. To give you a sense of how far we've come, in 2014, there were 40 deals, so the number of deals has quadrupled, or secondaries, I should say. And in 2014, the value associated with those secondaries was 35 million. Last year, it was 97 billion. So more than 100-fold increase. So I think we're adding a lot of capacity to the market with these SPACs, IPOs, secondaries. And SPACs are interesting because they're providing liquidity for venture capital firms who are taking companies public, perhaps a little sooner than might have otherwise have been the case. So the friction associated with that is slipping. I know there are questions about SPACs and the kind of fees that they charge, and we're glad that some of that is being exposed, and hopefully we'll see more transparency there altogether. But we do think the combination of the innovation platforms scaling themselves and companies rushing in to provide investors with exposure to them is going to answer a lot of these capacity questions.
Cathie, I would also add, from a global perspective, we're seeing some of these opportunities and these technologies scaling even faster in other parts of the world, like Asia. Do you want to comment on that maybe as well? That's also expanding the universe.
Very much so. Yes, very much so. And which is one reason we brought on Yulong, our Asian innovation analyst, because we see the amount of innovation around the world exploding, with Asia wanting to take a lead, especially China. So by our estimates, in the market, valued in the market today, in the equity markets globally, there's roughly $14 trillion in what we would call disruptive innovation. And according to our estimates, in 2030, that number will grow more than fivefold to 75 trillion. So that's the bucket we're playing in. So there will be more than enough capacity for our innovation strategies to scale globally.
Great, thank you, Cathie. Okay, I have a few questions related to the crypto markets. So these next few are for you, Yassine. The first is, will governments, do you think governments will create their own cryptocurrencies?
Stable coins.
Yes, we not only think they will, but we know that they have begun. I think China specifically, with the digital renminbi, is at the forefront of creating what is called a central bank digital currency, or CBDC. We often get asked the question what the potential impact on a government-created cryptocurrency would be to Bitcoin, and our response is that really the only thing similar to these central bank digital currencies with
Blockchain.
Bitcoin is the name or the label cryptocurrency. And that if anything, given the very nature of these digital currencies being still tied to the central bank monetary policy, this really just further reinforces Bitcoin as an alternative to central banking. If anything, these central bank digital currencies just provide a mechanism for governments to try to maintain control over their monetary policy, and then by extension over the economic activity and the flow of transactions between consumers across the country. We think that this will likely have more of a threat on commercial banks than on cryptocurrencies, in that a central bank will likely eliminate the need for a commercial bank by going directly to retail instead of traditionally going from wholesale to commercial banks to retail.
Yeah, and I would add to what Yassine just said, for those who are concerned about Bitcoin being shut down by governments, we believe that their decisions, and they are proliferating around the world, to issue their own CBDCs is actually validating the space and lowering the risk of Bitcoin being banned. And I also, besides the control, being able to understand what's going on in the economy, a lot of these central banks, effectively, there is no difference here. Their monetary policies are still going to be determined by human beings, as opposed to Bitcoin's monetary policy being effectively mathematically metered, and the inflation rate dropping over the years to effectively nil.
Yeah, this is a really good point. Like what she's talking about here. The more we see blockchain technology get used, the more people are going to invest in Bitcoin, the more people understand it. That's been my take on this channel for a while as well.
Any other thoughts there?
Yeah, I mean, I think what's really interesting is, the very fact that this is being acknowledged as a potential threat to monetary policy is definitely a change of tune from what we've seen just a few years ago. I think just this question alone goes to show how far Bitcoin has come from, being just this nerd money or this VC pump and dump money to now, governments questioning whether or not it poses a threat. In the U.S. specifically, I think at this stage it's going to be very hard to ban. At this point, there are just so many interested parties in Bitcoin.
It's not going to get banned. Let's move on.
Can press to shut Bitcoin down. So really, the more it establishes itself, the harder it is to stop. I think trying to ban Bitcoin today would really be an attack on the balance sheets of corporations like a Tesla or Square, on funds, on banks, on investors. And then given the borderless, apolitical nature of Bitcoin, nation states are going to realize that banning Bitcoin is like banning the internet, which means that for every country that bans it, you'll have another country that's going to actively promote it and going to attempt to encourage capital and talent from businesses and entrepreneurs who are actively involved in this industry. So at this stage, I think Bitcoin has reached a tipping point where it is not in the US's best interest to ban it. And we're likely going to perhaps see regulation, but I doubt an outright ban.
Yeah, and maybe, Yassine, you want to talk about the changes at the SEC in this regard?
Sure. So we know that Gary Gensler was nominated as SEC commissioner, which has been very interesting when discussing the implications for the crypto industry. We know that as a regulator, Gary Gensler is very likely the most well-versed regulator in the crypto and Bitcoin space. Prior to his involvement in the SEC, he was not only involved in the CFTC, but was also involved at MIT as a professor for a blockchain and crypto class. He was also an advisor for the MIT Digital Currency Initiative. All that to say that we feel very strongly about his understanding of the crypto space. Now, the implications from a regulatory standpoint, we know that Gary Gensler likes to regulate, and he will likely heavily figure out a way to establish himself in the crypto space by regulating it. But in the long term, I think that this will fare well for Bitcoin. And we have yet to see how it might fare for other cryptocurrencies. The recent news with XRP being deemed a security and questions around whether other crypto assets are unregistered securities, we might likely see negative implications there. But given his strong understanding of Bitcoin and how positively he's spoken about the blockchain opportunity, this is a net positive.
And I'd just add that the director of research of crypto at the SEC, and there has been such a person for at least, I think, 5 years now, she has been promoted so that she reports directly to the chairman of the SEC, Gensler. I don't think he's been formally appointed yet. I mean, he's been appointed, but I think the vote on him has to take place. But we're pretty sure that he's going to be in. So you've got two people really at the top of the SEC, extremely well versed in crypto. I would say that Gary Gensler is much more pro Bitcoin, and I would suggest that those other the Ripple-like crypto assets out there might have more of a problem than they would have expected now that Gensler is going to be in charge.
Okay, thank you, Cathie and Yassine. I'm going to jump back to Tasha. A few questions following up your research on autonomous. So the first is, what do you think about Waymo's CEO saying that Tesla will never achieve full autonomy?
Yeah, I think, there's another slide in our big ideas deck where we talk about the different approaches to autonomy. And so Waymo's taking a very different approach from Tesla, which is sort of, I'd say, what the majority of companies are doing. They're taking fleets of prototype vehicles. They're using LiDAR, they're using high definition maps. So they perfectly map the road that they're going to drive on. And then as the car is driving in real time, they're sort of checking back to that as the base truth to determine what to do. Whereas Tesla does not use high definition maps. It's a camera and radar based approach. So it's more of, deciding what to do in real time. That strategy has been critiqued by many as it's never going to work because, LiDAR is a more accurate sensor to pinpoint exactly where you are. You get a 3D point cloud back, it's super accurate. Whereas cameras is like a two-step process to determine if an object is there. But the argument for Tesla is that it's a more scalable strategy. So if Waymo were to launch in another city, John Kraftic had said that it took them roughly 2 years to launch where they are in Arizona now. So you can imagine another 2 years to really well map and get comfortable enough to launch in another area. Where Tesla's collecting information from, or is able to have access to information from customer cars wherever they drive. So that could be more of a national rollout for autonomy. And in fact, that's what they're saying. So I get the sense that that's where those comments are coming from. It's just, it's a sort of a backhanded critique, I guess, at the strategy. From our perspective, for our autonomous adoption timeline, if only the Waymo approach were to be what say happens in the next 5 years, adoption as a percentage of vehicle miles traveled would likely stay in like the low percentage points, looking out 5 years. But if Tesla were successful, and everything goes right, all the cars that they have available sign up for the network, you can see in North America that could actually approach something like 20% of miles driven. So our forecast is somewhat dependent on sort of who wins out, but I would say we're not dismissing that strategy outright for now, the camera-based strategy, because while it's unproven, it could be something where they're the first to do it, and then they're the first to launch on a national scale. And since we think this will be a geographic monopoly market, this could give them a huge advantage if they're successful.
Okay, thank you, Tasha. In another area that you cover, and this is a topic in Big Ideas 2021 as well, could you provide just a brief update of kind of the drone market and what we're seeing there over the next year?
Sure, yeah. So in the drone space, this is something that's really exciting because, as Cathie says, innovation takes share during tumultuous times. We really saw in 2020 a lot more experimentation with drones. Drones have really been taken off in the developing world, places like Africa and in Rwanda, where there's not as much infrastructure, and they really needed them to transport medical supplies, for instance. That's some of the first applications we saw and will likely see as it makes its way into places like the US. But yeah, in the past year, we've seen the FAA made some more I'd say like more detailed statements over exactly what they're looking for from the drone space. They've really put an eye to passing some of these projects along to being able to operate without line of sight, which is a really important requirement for what we think will be the biggest innovation that drone delivery gives, which is really cheap delivery. So once you take the human out of the loop, we think a drone operated flight would cost something like $8 for a 10-mile delivery, a human operated flight. And if you take the human pilot out, that could drop to as low as 25 cents. So we think this could be extremely disruptive for e-commerce and food delivery in particular. My colleague Sam has done a lot of work on the air taxi market as well. But those two opportunities in food and parcels, we think could both approach roughly 100 billion in delivery revenues over the next 10 years. And I think, again, we just sort of saw that kick-started this past year, which is pretty exciting.
Excellent. Thank you, Tasha. Okay, next few questions are for our next generation internet analyst, Nick. Nick, this is related to commerce as well. What do you think about, what does ARK think about the future of social commerce?
Thanks, Ren. This is actually an area we've been focused on a lot recently, and this is, I think, been turbocharged by the year that we've had and the growth of just overall e-commerce, and the recognition that social platforms, this being Facebook, Pinterest, Snapchat, Twitter, are actually not just great at top of the funnel marketing for e-commerce sites, but could actually be at the end of the funnel in terms of closing sales and having all of the shopping native on those sites. So that's really one side of the social commerce movement, is social media sites adopting e-commerce. And then the other side of this is traditional e-commerce sites like an Amazon, a Jet.com, adopting social features. And those range from live streaming to user-generated commentary on products, being able to share off of those traditional sites and push them onto social media platforms. So it's really two sides to the story. And we think this is really where e-commerce is headed. It's all going to be social. This is what e-commerce really lost, or I should say what e-commerce never had, was the ability to be able to talk in real time and understand what your friends like. And that's something that, people were doing in shopping, in malls and in physical stores. So we think the desire of the consumer to have this social feature is there. And we're starting to see a lot of big players pick up on this in the US and take notes. And I would preface this as a movement that really started in China e-commerce, with companies like Pinduoduo and Alibaba really taking the lead and pushing towards social commerce. So where is the market today? Well, the market's at, we believe, roughly 5% of the global e-commerce market. You can attribute that to social commerce. So that's about $215 billion today transacted in this social commerce. But we think that this is really going to balloon over the next 5 years. So we're modeling out right now just a 13-fold increase in terms of how much is transacted either on social media sites or through social features. So this is going to go from 5% of today's global e-commerce market to roughly 20% of the market in 2025. So it's a really, really big opportunity. And the players that are making, the efforts to adopt social features and move their, traditional social sites to adopt e-commerce features today are going to be in a very, very, very well-off position down the road.
Okay, one more for you, Nick. What do you think about online advertising and how that growth, we've seen the growth in last year, do you think that will continue into 2021 and beyond?
Yeah, and I say that pretty confidently because we have prior data on when there is a crisis and advertisers have to reevaluate where they're spending. They are going to, especially in crises, move to the most efficient platforms that typically are a lot cheaper, but more bang for your buck. And when we looked at this market over the year and reassessed our advertising forecast looking out, we took our kind of lead from what happened in 08-09 during the Great Recession, and what happened with print advertising. It was lagging in terms of print media as a format, dropping eyeballs for years and readership for years up until 08-09, but advertising dollars actually stayed with print all the way up until 08-09. But what then happened was a steep drop off and a recovery that never materialized for print. So if you look at what print does today in advertising, it's a fraction of what it did before 08-09. And we think the new print in this past year and during the coronavirus was linear TV, in that viewership of linear TV, and this is in the US, a $70 billion bucket of advertising revenue or spend. Viewership leading up until the pandemic had been going down, but advertising dollars had been staying with linear TV. Now we think we're going to drop off a cliff, and we're already starting to see signs of this. And all of that $70 billion whether it's in the next 5 years, 10 years, 15 years, are going to shift over to either connected TV spend or online advertising. So we think the rebound in online advertising happened and materialized much faster if you look at the past year, and will continue to grow sharply in the next few years.
Great, thank you, Nick. This next question is for Yulong, our Asian innovation analyst. Yulong, there's a few questions out there around Agora, given the recent price move. Could you just share your thoughts on the company and our view?
Thanks, Ren. Yeah, happy to. So for those of you who don't know about Agora, this is a platform as a service company that enables real-time communication. And when I say real-time communication, this is not just a typical Skype or FaceTime level of real-time communication. They provide many-to-many high-quality real-time communication up to millions of users per single instance, which is something very technically challenging, and even companies of decent size cannot afford to do, and don't have the time to do in-house. And we saw the stock rally pretty rapidly over the course of last several weeks. And I would say there are two main reasons that are attributable to this this rise. In mid-January, in China. Also, by the way, this company is based in China, and roughly 75% of revenues is currently generated from China. And in mid-January, with the COVID-19, especially the UK variant, resurging in China, in northern parts of China, we saw cities including Beijing having shut down schools. And with that, the online education is one of the key end markets for Agora. Is likely going to see a resurgence in usage. And the second reason is likely a more relevant reason for the stock performance, is the rise of Clubhouse, which many of you likely have heard of. So Agora is notorious for being the enabler of Clubhouse's real-time engagement solution, and is literally built within a single week during the beta stage. And the company is invite only currently still, and throughout last year, the data we saw were in the tens of thousands of users throughout the end of the year, and in the past months it has grown like a hockey stick, going to the last number I saw is around 3 million. And if you do a simple math of taking the list price of 99 cents per 1,000 minutes, which is the list price that Agora charges its customers, and you kind of map out this growth trajectory for Clubhouse, it's not very difficult to get to a very sizable revenue growth on a run rate basis for this year, which is not currently baked into the consensus numbers. That said, we do believe that as Clubhouse or Agora's companies that go from the startup stage to a home run, a massive hit, it's more likely that their customers will multi-source or engage in a volume discount type of situations. So that's something important to keep in mind. But overall, in terms of a long-term prospect of the company, we think Agora is a very interesting way, a platform agnostic way to play this virtualization theme that we have in terms of metaverse, in terms of more activities done virtually. With that, I will turn it back to Ren.
So I'll just add one thing there, Ren and Yulong. It is really interesting to see the Chinese develop this platform technology more effectively, because Zoom is the same thing that was developed in China. So Zoom and Agora both, as we face these virtualization challenges and opportunities. So they definitely have some core DNA there to offer us.
Cathie, you brought up a really good point. So both of the one interesting fact is both of the founders of Agora and Zoom came out of the founding team of WebEx. Yes, Zoom, most of their engineers a lot of their engineers are based in China. It's always been based here in Silicon Valley. And Agora initially was also founded and based in Silicon Valley, but they couldn't really find platforms that or customer startups that could use this real-time communication capabilities. Whereas in China, live streaming, online education, social commerce were really taking off. So over time, they had to take the team back to China and really service that parts of the world. So it's very interesting how the product market fit evolved, depending on what region of the world you're in and what kind of customer appetites you have.
Great, thank you, Yulong. Okay, I have some questions related to genomics for a genomics analyst, Simon. Simon, what do you think the characteristics will be for a company to become kind of a big winner in the genomics revolution?
Thanks, Ren. So I think I can point out a few things right off the bat that we think are important for companies broadly in the genomics space, many of which we think in whatever corner of the market they're in, whether it's instruments and tools or diagnostics or therapeutics, we think many of these companies are going to end up in a situation where they are kind of winner takes most. So a few things. I think the first one, importantly, is vertical integration, both upstream and downstream of DNA sequencing. So just to explain a little bit about what I mean here, genomic sequencing is the core platform that a lot of our genomics companies sit on top of. But in addition to that, it's really important that they're either thinking about, integrating forward with the technology to deliver care better, such as telemedicine integration, genetic counseling, things like that, or even before that, right? So the supply side, the synthetic biology components, being able to kind of print your own DNA or refine it and be able to kind of use that to improve how you run diagnostics or perform services or things like that. So vertical integration, we think increasingly it's becoming a service industry where patients and physicians are the customers. These are people who are constantly busy, and it's very difficult for them to stay up to date on new guidelines or recommendations. So the more that companies can alleviate that burden on their customers, the better. And then I think the final hallmark to point out here, and I think Cathie alluded to it earlier, is just an aggressive investment in research and development, right? So I think a mistake we think is considering R&D to just be kind of a thing that doesn't necessarily translate into new products or services or margin expansion, for instance. So we think that a lot of that investment does convert into those things over time. So we like to see companies aggressively investing in R&D to continue to increase market share and develop new products.
Okay, one more for you, Simon. Could you share your thoughts on 23andMe? They recently announced that they will be going public via a SPAC.
Ooh, I did a video on this. I'm interested to hear this.
Sure. Yeah. So, with SPACs, there's obviously a little bit of, opacity in there relative to a traditional IPO. I think there was a slide deck that was released on the announcement. So I would encourage folks to maybe go back and look. It seems like they're more heavily emphasizing the biotech and research and development and kind of pharma contract work rather than their previous, laser focus on direct to consumer genetics. So there is a little bit of a change, I think, versus the previous times we've talked about the company. But maybe to just highlight a few significant challenges we think that are associated with 23andMe. The first is that ostensibly their entire data repository and all of their clinical services are based on DNA microarrays, or something called genotyping, which is multiple decades old type of technology that offers just a sliver of the information that DNA sequencing does. So now we have companies in the space that are already switching from short read to long read sequencing to continue to invest in innovation. So by comparison, 23andMe is an order of magnitude or two even removed backwards from cutting edge tech. So we think it's going to be extremely difficult to switch the entire workflow from microarrays to sequencing. In fact, Ancestry tried to do this, and I think within a year of switching from arrays to sequencing, they actually closed their health business. So we think that could be a potential harbinger of challenges ahead for 23andMe. And then maybe just a few last things to point out. As important as user interface, user experience, and differentiated methods to reach end consumers, as important as those things are in healthcare moving forward, we think that circumventing the medical community, removing clinicians from the equation, and not having the infrastructure to do things like genetic counseling, these are all pretty significant weaknesses that we think 23andMe unfortunately is in the position of, whereas you have other companies that have already sort of mastered that arbitrage. So amongst a lot of different vectors, we think there's a lot of significant challenges and obstacles that the company will have to overcome if it wishes to be a significant player in the testing space moving forward.
Thank you, Simon. Okay, we have time for maybe two more questions. These next two are macro related. So Cathie, I'll direct these to you, and I'll try to combine a few of these here. So what are your thoughts on the Fed's high inflation target? Is there already evidence that inflation is on the rise? And is maybe the government considering the wrong indicators for inflation? So multi-part question there.
Okay.
If you could share your thoughts.
For sure. So on inflation, what the Fed is starting to flag is we are going to see an inflation increase. Estimates out there for year-over-year CPI inflation by April, May, June range from 2.5% to 4%. And the Fed has been careful to highlight this as a function of the base effect of the coronavirus. So last year, March, April, prices commodity prices and many other prices just dropped precipitously. So now we're going to be cycling against those comparisons, having recovered. So they will not be surprised by this, and they will probably hold investors' hands through this. We are seeing inflation expectations pick up in the bond market. We're seeing the yield curve steepen, which suggests perhaps that the bond market is saying, okay, the Fed is going to have to change its spots, meaning that the Fed has said it will not tighten until late 22 or sometime in 23. But the market's beginning to say, wait a minute, the Fed is going to face these inflation numbers, and they'll have to respond. So I think the Fed is jockeying into position around those comments and those forecasts now showing up in the marketplace by saying, yes, we expect this to happen. And what they've also said is, we are not going to be responding to that. And in fact, we would like to see inflation as measured, it'd be more by the PCE deflator, above 2% for an extended period of time, because it has been below 2% for such a long time. And we just want to get this deflationary psychology out of the market, which is a little bit anticipating the problem that Japan has had over these last 20, 30 years. Now, we believe actually that inflation is it will be and is being overstated, and that real GDP growth has been and will continue to be understated because of our statistical measurement systems. They were born during the industrial age. We're now in the digital age. They do go through revisions from time to time. I think every 5 years there are big revisions, but it takes a while, and the digitization, especially after the coronavirus, has just taken off. So we think that's a problem with the statistics. In terms of maybe the fundamental question of inflation or no inflation, we think there are two deflationary forces that will be at work during the next 5 to 10 years. One has to do with with innovation, and technologically enabled innovation is deflationary by nature. The deflation is a good deflation. It encourages more and more usage. It increases access. It unleashes waves of demand as prices fall. So that's the good deflation, not to worry about. We do believe there will be a bad deflation too, having to do, once again, with companies who are on the wrong side of change, on the wrong side of innovation, and have not been investing enough to adapt to what's going on. And many of those companies, as I described in the introduction, have been leveraging up for years to please short-term oriented shareholders with share repurchases that boost earnings growth beyond the level that the fundamental business is able to support. And so what will happen, we believe, and you've seen this in the retail space as it has been disrupted, you have companies that are being forced to cut prices in order to compete with the digital companies, and therefore they're having trouble servicing their debt. So that's a bad deflation. We don't think that's going to become systemic, and we do think that the good deflation is going to win the day. But that the bad deflation will be problematic for companies, and certain companies. So again, just do your homework and avoid those companies.
Okay, great. Thank you, Cathie. And that will conclude our webinar. Thank you to everyone who joined today's webinar.
I'm going to do a summary.
A replay of this webinar will be posted to ark-invest.com by the end of the week. So thanks again, and enjoy the rest of your day.
End of the week? It'd be old news by then. No, now. Now, this replay will be available. Well, it already is available. All right, let's do a summary. Let's talk about what happened here. Hold on, I gotta switch cameras. Oh yeah, look at that. I think this camera's a little too dark. What do you guys think? A little too dark over here? This one's better. Oh my Neo, what's Neo doing? I'm gonna do a recap. Give me one sec. Neo stock. Oh my gosh, it's up 5%. Finally, it moves. That thing sat at 55 for like ever. All right. Recap time. All right. I'm gonna do a full recap of this whole thing. That was like an hour long, so we're gonna make a short recap. Let's do that. Okay, I am ready to do a recap. I think. All right, here we go. Stop it, iPad. What are you doing? There we go. All right, let's do a recap. So here's the recap. I'm going to start like it's a new video. Hey everyone, me Kevin here. Cathie Wood and the team over at ArkInvest just put together a webinar, and well, it went on for about an hour and 5 minutes. I'm going to give you a complete recap and my commentary because, well, That's what I do. All right, so Cathie Wood starts off by saying the economy is going to be on fire as long as we get the stimulus package that we're expecting, which we think will be at least $1.5 trillion. Obviously, Biden's saying 1.9. So for some reason, Cathie Wood thinks the stimulus package is actually going to get ground down a little bit. We'll see what happens. She mentions that manufacturing is struggling to keep up because there's so much demand, and that right now we're not seeing any inflation going into people's wages yet, which is a sign that we're probably not seeing any inflation yet, but we should prepare for inflation coming in the future. More on inflation coming later in the summary. She does think that earnings profits will be explosive this year. When asked if stocks are in a bubble, she says she doesn't think so. Instead, she thinks, if anything, bonds are in a bubble. She mentions that some money has already outflown from stocks and gone into bonds, and she thinks bonds are in a total bubble. So, in other words, she thinks bond prices are too high. So we'll see. If there's a bubble anywhere, she says it's in fixed income, bonds as an example. She thinks in stocks, though, that there's going to be a big sort of bifurcation. So kind of like that K-shaped recovery we talk about with humans, where the rich keep getting richer and the poor keep getting poorer. She thinks that kind of same thing happens in stocks, or will happen in stocks. She thinks the winners in stocks are going to be leading edge companies on the leading edge of innovation, and that they're companies who are investing in becoming a part of the massive innovation future that we're seeing or will see in the future. Okay, well, that was a little complicated. Basically, companies that are innovating, yes, good. Other companies that are taking on debt to pay dividends, bad, losers, old. So new guard versus old guard. And she thinks basically the old guard is going to get crushed. Instead, she loves companies like Tesla and Roku, companies that can be global, and she thinks these are companies that are going to be winner-take-most companies. She is a fanatic about autonomous taxi networks. She thinks that these are going to be natural monopolies wherever they exist. She thinks that it might be possible that these companies, these robotaxi companies, have more success than we even think. I don't know if I said that already, but anyway, she's saying that robotaxi networks are going to blow up. We don't think stocks in a hole or in a bubble, she goes on to say. We think markets are enormous and global, especially at companies like Roku and Tesla. And because they're enormous and global, yeah, they might look expensive. Yeah, they might look like they've been going up, but it's because they're freaking awesome and they have so much reach. She does say that she thinks there are going to be, or already are, a lot of value traps in the market. Value traps are companies that look like they're becoming cheaper, but they're actually more dangerous to invest in over time. And then she started talking about Walmart, Costco, and Target, which I was kind of surprised that those kind of got mixed so closely together, because I didn't think that Walmart and Costco and Target were all that bad. But anyway, she encourages people be frosty, so to speak. Be aware and do your research, do your due diligence. Then she also slammed. She basically paper-handed us, y'all. And we love Cathie, but she just paper-handed. She came out hardcore on AMC and GameStop and said that these are moonshots, that their bonds like AMC have gone from 5 cents on the dollar to 80 cents on the dollar. And all that's really done is taken money from people who are investing in the stock and given it to the people who are investing in the debt. And it's basically a free bailout of debt. But she says the problem is you have a lot of people investing in these kinds of companies thinking that there's going to be some kind of resurrection of these companies, that these basically dead companies are going to come back to life. And she's basically like, good luck. Okay. Anyway. Then she talks about DNA sequencing, AI, blockchain, autonomous. Those are going to be things that are going to scale exponentially. These are the winners, she says. She also says there are going to be a lot of losers, though. And this is one of the reasons she likes investing in the bigger front runners, the winner-take-most companies like the Teslas of the world. Then there are, let's see, so that whole section was kind of her intro on the market bubble and that. Then we get into some Q&A, or actually some statements about Bitcoin. So let's see, on Bitcoin, we hear from Yassine on Bitcoin. One of our big ideas was that Bitcoin's role would evolve into a corporate cash role. And then Tesla legitimized that decision, and this is true, legitimized Tesla, obviously coming out and buying $1.5 billion of Bitcoin. Big deal. As a role of corporate cash, it's basically right along the line of what they thought would happen. They mentioned that if 1% of all companies put money into, well, I'm sorry, if all companies put 1% of their corporate cash into Bitcoin, Bitcoin will go up by $40,000. If companies in the S&P 500 put 10% of all of their money into Bitcoin, then Bitcoin could go up $400,000. Yeah, that's insane. Then let's see. Then there was talk about basically governments creating central bank cryptocurrencies. These are basically stable coins to just make transactions easier. They're not really investments. They're just, it's kind of like one stable coin of, let's say, the Federal Reserve. Like, here's the Federal Reserve cryptocurrency. It's not something you would invest in. It's just like one of this coin equals $1. And we're tokenizing it. So basically, we can transact faster and safer and across borders without having to deal with like wire transfers and ACH and all this clearing time and all this crap. And ArkInvest kind of came to this conclusion that commercial banking might get screwed in the long run. Like, bye-bye JP Morgan, we don't need you anymore because we're using these central bank coins. Now, in fairness to JP Morgan, I think they see the writing on the wall and they're already inventing their own stable coin. So they're trying to get ahead of the game. Let's see. Then they ultimately think that Bitcoin is going to continue to run and get to a $5 to $10 trillion market cap. In the chat here, we did a little calculation and determined that if Bitcoin goes to a $5 trillion market cap, each coin would be worth like, I think it was like $236,000 or something like that. Just dividing 21 million coins, right? So 5 trillion divided by 21 million. Do that math, and there you go. Whatever that works out to. They see Bitcoin as an... Oh, yeah. So then they talked about ride-hailing and Bitcoin combined. And this was kind of interesting. They're like, basically what they were painting the picture of, although they didn't use Tesla in this example, what they were painting the picture of is, imagine Tesla's doing robotaxis in China, and people want to get into the Chinese robotaxi, but then they have dollars and not the Chinese currency. Well, now you have an exchange rate and you have an exchange risk and it's a headache and blah, 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 blah. But now introducing Bitcoin, accepted in all Tesla robotaxis. You can pay Bitcoin anywhere in the world. It's the same thing. It's the same currency. That's kind of what they were alluding to here. They didn't say what I just said, but that's basically what they meant. So then they basically slammed Uber and Lyft. And they're like, yeah, Uber and Lyft don't even have a chance in this market. Sucks for them. They're going to get replaced by robotaxis. Also, my conclusion, they didn't say that. They had a much more elaborate explanation. Bottom lining, okay? They took an hour and a half, an hour and 5 minutes to say what we're going to say in 15 minutes. So we think robotaxis could be very profitable. They think it's going to be $1 trillion earnings market by 2030. That by 2025, robotaxis could have a $3.8 trillion enterprise value. That's obviously different from earnings. They think innovation in the future is going to 5x all innovative markets, and it's just going to leave behind all of the other crappy companies that exist, so to speak. They're really into this whole innovation thing, in case you haven't caught on to that. They're really happy that the dude who's going to head the SEC is into cryptocurrency. He's like, yeah, crypto, yeah, good. Okay? That was literally like a 10-minute conversation right there. On Tesla, they're like, oh, yeah, so sure, Tesla is doing things differently than Waymo because Waymo uses mapped roads and LiDAR and Tesla uses cameras, but we're siding with Tesla on this one. And if Tesla can crack the code, then they're going to be so far ahead of everybody else because they're using this camera technology that nobody else has been solely relying on. Kind of a bullish thesis there for Tesla, but it's also a potential risk for Tesla. So if Tesla's camera tech fails, then it's a problem. I think worst case scenario, Tesla has to come out, slap LiDAR into their cars by replacing all the mirrors in the cars, put like a microvision LiDAR in the mirrors. Boom, now you got forward-facing LiDAR. Perfect, you solved the problem of not having had LiDAR in Teslas. I don't think it's that big of a deal. It could be done. It could be expensive to retrofit the cars. So go back and fix up those cars that are on the roads. They didn't talk about that. They're kind of like, yeah, cameras, good. So we'll see. Then they talked about drones. Like, yeah, so drones, good. We really like drones, they said. We think it costs a human operating a drone $8 to deliver a package 10 miles. So a human with a joystick, let me go deliver your Amazon package or whatever, right? And they're like, well, meep, if we can just have a robot do it, and it's going to be like, I just did the same work for 25 cents because the robot's doing it. So obviously that's, what is that? 4 times 8 is 32. That's 32 times cheaper to just have robots flying themselves to deliver packages and deliver food. So drones, they're really bullish on that for the future. They think there could be $100 billion in delivery revenues by drones in 10 years. Another transformation, they think that social media sites are going to incorporate e-commerce more. And then websites like Amazon are going to incorporate social media more. So you're basically, she's kind of predicting like this. Like Amazon has more social media and social media has more storefront stuff. Which is kind of funny because like 3 years ago, before they had like merch stores on YouTube, I had a video. It's still up. It was like 3 years ago. It was definitely 3 years ago. It's 2018. I made a video and I'm like, one day YouTube will literally have a store where instead of you having to go to like meetkevin.teachable.com to see my courses, which you can get with the coupon code HODL down below, or HODL, depending on how you say it. But that there will just be a shelf below the videos for like courses and e-commerce products of all types. They then later came out with the Teespring stuff where you can get like shirts and mugs that show up below videos. I think that's going to blow up. Like not the Teespring stuff necessarily, but selling whatever the heck you want in the future will blow up down there. And then YouTube will just take a commission and they'll have like reviews and stuff like that. So I kind of agree with Ark on this. And this is something that I've kind of been thinking is something that's almost been needed. Like, I don't want to think of myself as like, oh, I'm genius. I'm thinking like ArkInvest. No, it's more like it's a duh. It's a no-brainer, right? But then they're also saying that Amazon, and this was more interesting because I didn't think of this. They're thinking that Amazon might become more of a social platform where it's like you could start seeing what your friends are buying and what your friends think about products and what your family's buying. That was interesting. Like a social network on Amazon almost. Okay, whatever. They're really bullish on that. Okay, they're modeling a big increase in that. They think advertising on TV revenue, which is a $70 billion advertising spend per year right now, is going to basically fall off a cliff. And all that money is going to go online or to connected products, which could be like connected TVs or maybe even Peloton. I don't know. Then regarding the rise of Clubhouse, they didn't like the idea of investing in Clubhouse as much as they liked the idea of investing in this company called Agora.io. So go to Agora, Agora.io, ticker symbol API. It's a Chinese company. 75% of revenue comes from China. And basically it's like the back end for like a Zoom or a voice channel like Clubhouse. On genomics, they think that the big priority is figuring out how to deliver better care with telemedicine, but then also investing a lot in R&D for having better care for people, like actually treating stuff. Okay, I mean, we get that. So that wasn't too surprising. They totally ragged on 23andMe. I didn't like 23andMe either. I did, but my thesis was totally different on 23andMe. Like I did a video on 23andMe. I wasn't happy with it. They had a really cool thesis on 23andMe, and they're talking about how 23andMe uses microarrays when they look at your DNA to sequence your DNA. And they're like, yeah, that's like super old school. Like we're on short sequencing right now, and we're already moving into long sequencing of the genome, which I guess is like the next level to the next level. That's the way they explained it. And then they said Ancestry moved away from microarrays. And after that, they realized like, oh, crap. Yeah, that's really old school tech. And they think that's like, bad news for 23andMe. Then on inflation, Cathie Wood comes back on and says that she thinks we're going to see. Oh, she talks about, and I've talked about this on the channel quite a bit too, that in April, May, and June, and I've mentioned this many times, we are going to see inflation come in potentially as high as, she says 2 to 4%. I think between 3 to 4%. And the reason is because inflation readings were so low last March, April, and May, and June, because the pandemic just hit and prices fell. And so year over year, we're going to see inflation come in high. I personally think that's going to lead Bitcoin prices to go up in you know, April, May, and June. But then when inflation readings go down again, even though they're antiquated measures of inflation, it's possible that people could be like, oh, I thought there was going to be a lot of inflation and now there's not. And then they're like, oh, I guess we don't need Bitcoin anymore. And who knows? There could be a fall in Bitcoin pricing. So just something to be aware of. And that's just my thinking, right? But she talked about that. She is a little bit more of the mindset that the Fed is going to raise rates sooner. I don't align as much with her on that. I think she thinks the Fed is going to potentially raise rates as soon as potentially early 2022, the way she's talking. I think the earliest starting right now that the Fed would raise rates would be 18 months from today, which would be closer to the end of 2022. So she's a little bit more bearish on that than I am. And she actually thinks that Bitcoin is an inflation hedge. There are a lot of people that argue that and go, no, Bitcoin is not an inflation hedge. Whatever. Everybody's got a different opinion. You got to make up your own. Then she talks about how deflation is actually a good thing when it's technological deflation. A really cool split on the deflation argument, that deflation for technology is good because more people buy it. Like when phones become cheaper, smartphones, more people have a smartphone. Makes sense. I made that example up, but that's what she meant. Bad deflation would be like prices go down, but you're a struggling company and now you can't pay off your debts because you're getting less revenue. And that sucks. Good deflation would be prices are coming down for products, more people can buy it, your profit goes up because more people can buy the product. Kind of like a LiDAR argument, actually. That's really annoying. Kind of like a LiDAR argument. You know, as the price of LiDAR comes down, more people can use it. That would be a good form of deflation. That was it. Yep, cool, perfect. So, hey, if you like my perspectives, make sure to check out the course down below and use that coupon code HODL or HODL. It is down below. Thank you so much for watching this recap of the ArkInvest video. If you found it helpful, consider sharing this. And folks, we will see you in the very next video. Thanks again for being here. Bye.